is indeed a great privilege to chair the opening plenary session of what I believe is the best conference in the conference calendar for our industry. And I'm also pleased to be introducing Lewis South, who is the Chief Economist at Macquarie Funds Group. It's interesting to reflect on where we were 12 months ago, in Port Douglas actually at the conference, but in terms of the economic environment, we had Goldilocks economies, nothing too hot and not too cold, and strong investment returns, with really only the faintest hint of storm clouds on the horizon. And Lewis, in his presentation today, refers to the golden age. But a critical question for us all to ponder now is, will the economic environment be helpful for investment returns, or will it be a hindrance? And that's the question that Lewis will address in his presentation. Lewis heads the economics team at Macquarie Funds Group, whose role is to monitor developments in the global and domestic economies with the view to making an assessment of the economic outlook for growth and inflation in both the near and long term, and the implications this has for monetary policy. Prior to this, Lewis worked as an economist at the Reserve Bank of Australia for 6 years, analysing international economic developments, in addition to analysing developments in the domestic banking sector. In Lewis's spare time, he is a rugby league referee. He says that this reflects his sadistic streak. He likes to cop abuse. I guess during the week, that refers to abuse from the traders, and at the weekend he cops abuse from players and spectators. But he does say that this helps with his decision-making. So hopefully in his presentation there won't be too much of the economist speak, on the one hand this and on the other hand that. His personal motto is, if at first you don't succeed, don't take up skydiving. Please join with me in welcoming Lewis.
Well, thank you very much for the introduction, and can I just say what a pleasure it is to be here talking to you today. As Maria mentioned, I'm going to spend a bit of time later on talking about this issue of what Maria called the Goldilocks economy, what I like to call the golden age, and whether or not the conditions which really characterise that period are likely to continue moving forward, or whether we might see something more challenging. To start with, though, I want to spend a little bit of time just focusing on the more near-term outlook for you. And focus a bit on where we think the global economy will go over the coming 12 months and interest rates. Just to give you a bit of a summary on that 12-month outlook, we are relatively optimistic on the global economy as a whole, with a couple of caveats which we'll discuss. As a result of that, we're also relatively optimistic on the Australian economy. I think you're obviously, as Maria mentioned, no doubt well aware of the significant strains in credit markets which have existed now for the better part of a year, and have really driven the very poor performance of financial markets as a whole. So I don't really want to spend too much time focusing on that today, except to say that unfortunately we can't really see an end in sight to those conditions. Particularly the volatility in financial markets we think will continue at least until the end of this calendar year. I think likewise any discussion of the current economic outlook, you have to at some point reference it to the very significant problems in the US housing market, which of course was the initial catalyst for the concerns that we see in global credit markets. Again, very well known, I'm sure you're all well aware of this situation, and again I don't plan to focus on this too much, except to just remind everyone of the unprecedented decline in house prices which has occurred over the last 2 years, and which we can see on this chart. I think what's really important about this is that conventional wisdom for economists was such that this very significant decline in house prices was going to drag the consumer down with it. And we're going to see very significant constraints in the consumer as early as the early part of this year. But the evidence to date actually shows that this probably hasn't been the case. Real consumer spending has certainly slowed, but most of that has to do with the fairly sharp increases we've seen in consumer prices. Particularly the prices of petrol, which has really crimped real discretionary spending power, not just in the US economy but pretty much all everywhere globally. And as you can see from this chart, nominal consumer spending, which is probably your best sign of consumer stress, has actually been continuing to grow at a fairly steady pace around about its long-run average level. This is quite surprising given that very sharp decline in house prices that has occurred over the last 2 years. There seemingly hasn't been a significant wealth effect come through at this point. And of course you'd be all very aware that a very sharp fall in the US dollar has really boosted the external sector in the US economy. We've seen net exports grow very strongly, and as a result of that the US economy until this point has really confounded the sceptics, continued to grow at a fairly robust pace. So, is that going to continue, or could we actually see something more sinister ahead? Well, unfortunately for us, we actually think that exactly the same time that the economy is surprised to the high side of expectations, some very significant storm clouds have actually gathered in the form of a fairly clear deterioration in the labour market. And we actually got an update on this just on Friday, and the US unemployment rate jumped quite significantly to 6.1%, not shown on this chart, from what was a 5.7% rate in July. And really, what's quite interesting is if you look at this chart for the unemployment rate, is just the eerie similarities that the current movement in the unemployment rate is holding compared with the past downturns, particularly the one in the early 1990s. And this, I think, more than anything, really casts some significant doubts over the outlook for the US consumer, because despite all the focus on house prices, when it's all said and done and you put everything into the wash, what really comes out to you is that the biggest driver of consumer spending is income growth. And the biggest driver of income growth is employment. If the economy is shedding labour and the unemployment rate is increasing very significantly, then the consumer will weaken, and weaken potentially quite dramatically. And we're already starting to see this now coming through. In fact, in the current quarter, real consumer spending in the US is poised to contract for the first time since 1991. So a fairly significant development. And I think that makes us pretty cautious actually on the outlook for the US economy. Things have looked great so far, but we're quite worried about where that economy will head over the coming 6 months to a year. I think at the same time that that is happening, it's also very clear signs of a weakening in growth in the other major advanced economies, I think most notably in Europe. Now, this chart looks at business conditions, and I think what really stands out here is the conditions in the UK and Spain. Now, these are two economies which really shared the most in common with the US. They both experienced debt-fueled significant booms in their property markets over recent years, and that boom in property markets are now deflating, and deflating in a fairly significant fashion. And in both cases, business conditions have dropped very sharply to levels which are normally consistent with downturns in activity. And in Spain in particular, conditions are looking very, very poor. We've already seen this now starting to come through in the data. European activity actually contracted in the current quarter, and the UK economy is poised also to contract and fall into what we believe will be a recession in the second half of this year. That's kind of the bad news. The good news is that despite this fairly significant weakness in the advanced economies, the International Monetary Fund still believes that global growth as a whole is going to be fairly robust. Sure, it's not quite as strong as it was in the last 4 or 5 years, but the sort of numbers which are currently forecast are really just a return to around about its long-run average levels. And that's despite the fact that the International Monetary Fund is actually forecasting growth in the major advanced economies to be as bad as it was during the 2001 recession that those economies experienced. So, it's interesting to sort of see what's going on here, and really the big driver is the continued strength in emerging markets, and of course most notably China, which is expected to grow north of 9.5% this year. So let's have a bit of a look at the outlook for China and emerging markets in a bit of detail. Contrary to popular opinion, we're not really convinced that Chinese growth is driven by export prices. We think really the fundamental driver on a long-term basis for the Chinese economy is demographics, and in particular this long-held policy of urbanisation. China is still an extremely rural population. About 40% of its population live in the cities at the moment, and that's well and truly up from a level of about 20% 2 decades ago. And you can see that from this chart that they are on this process of urbanisation, and it's expected to continue over the next 2 decades. Pretty modest, actually, in terms of what we've seen in the past, the likes of Korea fairly recently with their rapid pace of urbanisation. Now, we've seen this many times before without having really significant impacts on global activity. But this is where scale is really important, because Korea doesn't have 1.3 billion people. China does. So this slow, steady urbanisation suddenly translates itself into approximately 350 million people moving from the rural areas to the cities over just 2 decades. To put that in a little bit of a context, they have to build the equivalent of Australia's housing stock every 18 months. And that's really only the tip of the iceberg, because what's really important from this urbanisation process is an extremely significant infrastructure demand that requires as a result of that. Not only do you have that housing story, as we've termed it on this chart, the equivalent of the US entire population having to be housed in the cities, but there's also significant other infrastructure that goes with that: roads, rail, water, and then office space. And the one I like particularly on this chart is over the next 2 decades the equivalent of 10 New York Cities worth of office space needing to be built. So very significant infrastructure demand, providing long-term support, we believe, for commodities in particular, as you roll through not just the next 5 years, but over the next decade. So let's just turn to the domestic economy now. A slowdown in activity in Australia is very, very evident now in the data. In fact, last week we got an update which showed that growth slowed to its slowest pace in 5 years. Clearly, the main driver of this has been the consumer, which is exactly what the Reserve Bank has tried to achieve via increases in interest rates over the recent year. In addition to that, we've seen a very significant increase in prices, and that's driven consumer spending down to its lowest level we've seen for some time. Consumer sentiment, which is the blue line on this chart, is at levels we haven't seen since the early 1990s, and real consumer spending fell for the first time since 1993 in the quarter just gone. In fact, this slowdown has been so significant that the Reserve Bank just last week cut rates for the first time since 2001 by 25 basis points. Now, the market believes that they are going to continue to cut rates over the coming 12 months, probably by two further times by year end, and by a full percentage point by the middle of next year. Against that view, we're a little bit less optimistic. We're not quite sure the Reserve Bank will be that aggressive in cutting policy, and this reflects several factors. The first one is that, as we're all aware, tax cuts, which came effect from the 1st of July, we believe will provide some support to the consumer, and the numbers coming out over the next couple of months we think will show that. Secondly, despite that pessimistic view on the advanced economies, Australia actually is continuing to get stimulus from the global economy as a whole, and this in turn reflects two factors. The first one is emerging market strength really driving up the prices of the commodities that Australia produces in abundance. And we've seen just this year very sharp increases in contract prices for coal and iron ore in particular. And that's driven our terms of trade up to levels we haven't seen since the mid-1950s. The second part of that, though, is that trading partner growth for Australia is much stronger than what you'd think based on the slowdown in the advanced economies. And the reason is, as you can see on this chart, that our trading partner patterns have changed very dramatically just in the last 10 years. In 2001, the US was our second largest trading partner, taking about 10% of our exports. Today, they're our fifth largest trading partner, taking about 6% of our exports. China has suddenly boomed from being well down the list to now being quite clearly our second largest trading partner, and on current trends will probably take over Japan in the next 2 to 3 years. And India also increasing very sharply. In other words, we are now trading increasingly with the economies which are the driving force of global growth. Those emerging market economies where the outlook over a period of the next 10 years or so looks quite bright, particularly relative to that for the advanced economies. What that means is that growth in our trading partners is significantly stronger than you might otherwise think. You can see here the extreme slowdown in the advanced economies forecast by the International Monetary Fund, as I mentioned before, the weakest since 2001. But our trading partner growth, once you put into the strength we have to emerging markets, is actually growing at a fairly strong pace. Yes, again, like the global economy, it is down from the pace of 2006 and 2007, but well and truly above that rate we saw in 2001, which was, I would remind you, a period where we didn't really follow the US in a recession. This is having quite a strange effect, because despite the fact that there's these very significant headwinds in credit markets and the slowdown in the Australian economy, which has been well known for some time now, business investment plans, because of this external stimulus, are extremely strong. In fact, businesses are saying they're going to increase their investment at the fastest pace we've seen in at least the last 2 decades. And in fact, despite what we've seen just recently, businesses actually revised up their investment plans quite significantly in the last couple of months. And this is going to help to offset the slowdown in household spending. I think the final reason why we're less confident we'll see significant cuts from the Reserve Bank in the short term is that we still have inflation problems. Inflation in Australia is at its highest level since the early 1990s and is higher than any time when the Reserve Bank has been targeting inflation, and it's well and truly above that inflation target. And if you look at the Reserve Bank's target and look at their forecast for inflation, they're not expecting inflation to fall back within their target band until the second half of 2010. So basically about 2 years from now. So unless we see growth weaken quite sharply and a lot more than what is expected by pretty much anyone out there in the marketplace at the moment, we can't really see the scope for significant cuts in interest rates. We think the Reserve Bank has pretty much signalled this as well, in terms of couching their rate cut last week, in terms of reducing the restrictiveness of policy rather than actually moving to stimulate demand. And so on that basis, we think fairly modest cuts for now. So in terms of what this all means for the outlook for policy, well, a week ago the market was factoring in a rate hike in the US. In fact, about a month ago they were factoring in a rate hike by year end. We think that's premature. We think, if anything, the Federal Reserve will look to cut rates over coming months on the back of concerns that we think will become very apparent in the consumer sector. We think the monetary policy elsewhere will be fairly desynchronised. Bank of England, the New Zealand Central Bank, we believe, will be cutting rates on the back of very significant growth concerns, whereas unfortunately for Spain, the ECB, we think, is unlikely to follow those rate cuts because they are much more strict adherence to inflation targeting than is the case in the other economies. In emerging markets, we actually think will continue, if anything, to be tightening policy over the next 6 to 12 months. And for Australia, as I mentioned before, unfortunately limited rate cuts for now because of inflation being elevated, and we think some offsets to the slowdown in consumer spending which has become evident so far. So we think probably, including the rate cut we had last week, 50 basis points in total by year end, and no really significant easing in policy until the middle of 2009, at which point it becomes more evident to the Reserve Bank that inflation is slowing as they want it to. So now what I want to do is actually go on to address that issue that Maria mentioned in her opening remarks about what she called the Goldilocks environment, or I like to call the golden age for financial markets. That period of very strong, stable growth and, as a result, very strong performance of financial markets, which in particular characterised the first 5 years of this decade. And I think to begin with this, we need to really discuss what were the drivers of that golden age so we can look to see whether they're likely to reassert themselves over the period ahead. Now, the key driver of the golden age, and this is the most technical I'm going to be today, was a significant positive supply shock which came from the integration of emerging markets, particularly China, into the world economy, that globalisation force. Now, this allowed the advanced economies to really tap in and benefit from China's position as an extremely low-cost producer of consumer goods. And of course, China, undergoing this urbanisation process, also benefited enormously because it provided jobs for this newly urbanised labour force. And it allowed China to really tap into some very significant economies of scale. The net result was that Chinese export prices were falling on net for quite a long period of time, from the mid-1990s through until the first half of this decade. China was exporting disinflation to the rest of the world. This was of enormous benefit for advanced economies in particular, because in the early 1990s, pretty much every advanced economy adopted in some form a measure of inflation targeting, whether it be an explicit target or a more implicit target. And that target generally revolves something around about a 2% rate for inflation. And you can see if goods prices from China are falling at a rate of 2 to 3% per year, it's pretty easy for central banks to hit that inflation target of plus 2%. They don't really have to work too hard. And we really saw the end result of this in the fact that official cash rates from central banks were able to be held at fairly low levels. And what's really interesting about this chart is the first signs of weakness in an advanced economy's growth that we saw in 2001. Because inflation was low and contained, central banks were able to respond with significant easings in policy. And we saw interest rates reduced to extremely low levels where they were sustained for a very, very long period of time, a pretty much unprecedented period of central bank behaviour supporting growth. So we have very low, stable inflation. We have central banks really supporting growth. What do you get as a result of that? You get very stable conditions in financial markets. And this was a very broad-based story, but was particularly evident in the volatility measures in interest rate markets, which is what the volatility measure I have on this chart shows. You can see just how low volatility had fallen to in the first half of this decade compared to the norms of the last 2 decades. So what happens when you have extremely strong growth? You have low inflation, central banks doing everything they can to support growth, and you have low volatility, financial markets boom. And in particular those which are fuelled by credit. Australia, I think we saw this most evident in the performance of our equity market, and the All Ordinaries growing at that very strong, more than 20% pace for a period of 4 years, a really once-in-a-20-year boom in our equity market. Unfortunately, as we know, all good things come to an end at some point, and we've seen that very abundantly clear in the performance for financial markets in the last 12 months. So what has changed? Well, really 2 things, and they all reflect that positive supply shock now having come to an end. The first part of that, which is the one you're probably most familiar with, is that emerging market demand has pushed up commodity prices very sharply. Again, a very broad-based story. We saw that in coal and iron ore in particular for Australia. We also saw it very much in petroleum and oil prices, which until recently had grown extremely strongly, peaking at $145 a barrel, more than double their level of a year ago. Now they've come back a bit. We're suddenly very excited about oil maybe getting back to $100 a barrel, which was quite interesting because it was $50 a barrel only 3 years ago. And certainly that very low, stable oil prices we saw earlier this decade is really a long-gone memory. What this has done is it's pushed up input prices for businesses right around the world, and it's constrained consumer spending as well. The second element to this, and one that you're probably not quite as aware of, is that China is no longer exporting disinflation to the rest of the world. In fact, quite the opposite. Chinese export prices are now growing at an extremely sharp pace and is continuing to accelerate. And we can see in this chart that they're growing at a pace we haven't seen since the early part of the 1990s, before central banks in the advanced economies began to target inflation. Suddenly now it's becoming extremely hard for these central banks to hit their inflation targets, now that China is no longer giving them that benefit of exporting disinflation. Lo and behold, headline inflation in the advanced economies has accelerated, again to levels we haven't seen since the early 1990s, and we're getting up around 2 percentage points above what most central banks have as their target for inflation. Again, as you can see from this chart, that very steady low inflation rates we saw for much of the last decade or so really now looks to be a foregone conclusion. It's well and truly gone. Now we have inflation volatility. We have weaker growth. We have central banks which in the short term, particularly if you're in the UK or in Spain, which are unable to respond to that weakness in growth by easing policy as aggressively as they have before. We start to get volatility. And the key thing here is it's renewed volatility, because the volatility levels, as you can see in this chart, really aren't that unusual compared to the history of the last 2 decades. What really stands out is just how low volatility was in this golden age period, and just the benefit that we were getting in financial markets as a result. So what about the future? That's what we're really focused on here. It's what we're really interested in. It's great to have a bit of a history lesson. It's great to look at what's happened. We need to know, well, are these conditions going to reassert themselves? Are we simply seeing at the moment a brief hiatus and a new golden age is going to reassert itself over the next 5 to 10 years? Certainly if you look at what most economists are saying, they're not too worried about inflation. And the reason they're not worried is because of the slowdown in the advanced economies. They think that that will solve the inflation problem. We're not quite confident, certainly nowhere near as confident as other economists are on that point, for one very simple reason. We do not believe that the inflation driving forces of the last 12 months have been the advanced economies. We think the economies which have been driving the inflation forces over the last 2 to 3 years have been the emerging market economies, economies which are expected to still grow at a fairly robust pace over the period ahead. In particular, we don't think the advanced economies are the driving forces for commodities. And I'm going to step through this in a little bit of detail now. What this chart does is it looks at the share of total world GDP and commodity consumption in 2007 for the main 7 advanced economies. And it compares that with the 4 main emerging market economies, which are dubbed the BRICS. Do we all know what the BRICS economies are? Brazil, Russia, India. Anyone can guess the last one? Chad. China, of course, sorry. China. The advanced economies last year, 55% of world GDP. Yet for the major commodities, their share of total demand was well down from that. They were punching well below their weight. Now look at the BRICS economies. They were just 12% of world GDP last year. But in every single major commodity market, they were punching well above that weight. Let's look at coal. 50% of total demand for coal from just those 4 main emerging economies. About 40% for steel. China, of course, being the dominant driver of those. Oil's quite an interesting one. I want to focus a little bit on that now, because you can see that the emerging markets, only about 18% of total oil demand, pretty small. And this really illustrates the second point, that it's not just the total level of demand, but the incremental change in demand that's really important. And we look at who is driving incremental demand for commodities, it really becomes very clear that it has little to do with the advanced economies and a lot to do with the strength we're seeing and continuing to see in emerging markets. Particularly also in oil. Remember, they were just 18%, the emerging markets, of total oil demand. But last year they contributed 60% of incremental demand for oil. And look at what happened in the advanced economies. They actually reduced their consumption of oil last year in 2007. And yet despite that, the price of oil doubled, despite advanced economies slowing down their consumption. And I think that really illustrates quite clearly the limited role that the advanced economies are actually playing out in terms of the long-term trends in commodity markets. And again, if you look at other commodities, how significant those 4 main emerging markets were in terms of driving incremental demand. In the case of coal, about 80% came from the main emerging markets. In the case of copper, it was more than 100%, again with China being a big part of this story. So if we believe that the emerging markets, because of these long-run demographic factors, over a long period of time will continue to grow at a strong pace, then demand for commodities, we believe, will also be fairly strong over that long-term period. Unless we start to see fairly significant supply response, and to date that's been very constrained by a number of factors, then commodity prices, we think, will continue to get support over a more medium-term basis. You certainly will get volatility around that, but as you roll through the next 5 years, I think it's fair to say that the level of commodity prices will remain at a much higher level than we've been used to. What this means for us is that we think that producer price inflation, input costs for businesses, will remain relatively elevated from what we became used to through the Golden Age period. We certainly don't think it will be as strong as what it is for the advanced economies at the moment. You can see that producer price inflation accelerating to a level we actually haven't seen since the early 1980s in the major advanced economies. We don't think it's going to stay quite that high. But we don't see how we're going to return to that very low and sometimes negative rates that we saw through the Golden Age period. Again, this is a constraining impact for central banks when it comes to their targeting inflation. It makes it harder for them to achieve it. Now, economists may well be right. We may not be able to see pass-through of these input costs into final consumer prices because of a slowdown in advanced economies. That's certainly a realistic prospect. But all that will tell us is businesses will be wearing profit margin contraction. Either way, whether it be central banks not able to support growth as we're seeing at the moment, or businesses wearing reduced profit margins, the outlook for equity markets that come from that, and in fact all asset markets, is not quite as positive as the outlook that we've had over the last 10 years. So let's just provide a bit of a summary now. In terms of the current backdrop, unfortunately we think that the negative news, risk aversion, the credit market constraints are set to continue at least through the end of this year. We do still see, despite that, concerns about the US outlook in particular, reasons for optimism about the global economy, particularly from Australia's perspective, because of the continued robust growth in emerging markets. The result of that being we don't think the Reserve Bank here will cut rates quite as quickly as the market expects. For the big picture, unfortunately, we can't see the golden age for financial markets returning. Rather, the macro picture moving ahead we think will be more challenging. We're going to get a bit more inflation, particularly more inflation volatility. The result will be that central banks will not be able to support growth to the extent we saw previously. We're not talking here about doom and gloom. We're simply saying there's very strong performance for financial markets the last 5 years will not likely be repeated. The unfortunate situation is a return to what I would dub more normal conditions, the conditions that we saw through most of the 1990s, where equity markets returned that traditional 8 to 10% long-run return. Thank you very much for listening to me today. Thank you.